Hi guys, welcome to the video for Workshop 6. We are wrapping up the course, doing chapters 9 and 10 this week. Chapter 9, let's go ahead and get into it. We're talking about liabilities here, and the difference between a current liability and non-current liability is the same difference between a current asset and a non-current asset. We have that 1 year threshold. Anything over a year is going to be a non-current liability. Things that are under a year are going to be a current liability. Why is this important? Well, if you are a company, you would like to have your liabilities be non-current liabilities, because when you do your ratios, remember we did current ratio, where you do current assets divided by current liabilities. Your ratios are going to look better if you move these liabilities to non-current liabilities. When investors look at your ability to pay your debts, remember that's liquidity, your financial statements are going to be better off if they're classified as non-current liabilities. So sometimes you get into disagreements with auditors about when things are coming due or the terms of agreements, and this might be a subject of contention in certain things, but the general rule is over a year it goes into non-current liabilities. There's a lot of known liabilities that are listed on pages 366 through 369. Okay, let's go ahead and talk about the payroll accounting. This is one of the staples of the first accounting course wherever you take it. This is typically something that you'll learn. The book does a good job of explaining it on pages 369 to 372, so make sure you look at that. We'll go over the entries. One of the key things you need to make sure you understand is there are taxes that are paid by the employee, taxes that are paid by the employer, and those that are paid by both. So the ones that are paid by the employee, federal income tax, any contributions that you have to charity, any retirement, those type of things can be withheld from the employee paycheck. Taxes that are paid by the employer, you have your unemployment taxes. Those are always paid by the employer, and then the FICA taxes are paid by both. So that's like your Social Security and Medicare tax. Now, let's go ahead and look at the entry for whenever we record the employee payroll taxes. Kind of written it out here. Payroll expense, this is the amount that's going to be the gross. You can kind of think about this as the gross amount on your paycheck. If you were paid $20 an hour times the number of hours that you work, this would be the debit right here. Now, you know, since all you have worked before, that the amount that you earn as your gross is not going to be the amount that you're going to get paid in cash. You have all these other withholdings. Your FICA, this is your Social Security and Medicare, they're going to withhold that. Your federal income tax, this is the big amount, the largest amount that's going to be withheld from the paycheck there. Any insurance that you pay, any charitable contributions, you know, a lot of times you have United Way contributions that come in and they'll take it straight out of your paycheck. They can withhold it and show it there. And then the net amount, this is the net down here, salaries payable cash. If it was paid right away, we would credit cash. If it was paid later, we would take it to payable first, salaries payable, and then we would debit this and credit cash whenever we paid it. So all these here are going to add up to the gross, but we're going to be taking these out with the credits to the payables. Now, if say this was at the end of the month, 12/31, whenever we actually paid these, say January 10th, all these would be debited and our cash would be credited. These aren't typically going to be on our books for a very long period of time. These are definitely current liabilities, and we're going to have to remit these taxes or these contributions to their rightful owners in a short period of time. That's kind of what the payroll department does. Okay, from the employer's point of view, we have another journal entry that we have to make for the payroll expenses that they're required to pay. Remember, we said a minute ago, those are the FICA taxes and the unemployment taxes. So that entry is on page 372. Make sure you review that, but I've written it out here. This is payroll tax expense is debited. The FICA payable for your Social Security and Medicare is going to be credited. And then this is your state unemployment tax or federal unemployment tax. These are both going to be payables as well. These total to the total payroll tax expense. Now, this is calculated based on the amount of what our gross was on the other page. So the calculations, if you have a problem, will give you the total amount of payroll expense that company has, and you'll be able to calculate these with the percentages that they give you. These are pretty low percentages. This is a little bit higher of an amount for a payable. So make sure you understand that when we first did the first entry, that was paying the payroll and withholding from the employee. Now this is an extra entry that we have for the taxes that are associated with the employer. Last thing on Chapter 9, a contingency. Just as in life, contingency in accounting is something that may or may not happen. When it comes to contingency, conservatism is our overarching principle that we follow. Remember, conservatism says If we do not know, we're going to pick the option that shows the least amount of assets and the least amount of net income. So if something is a contingency, we're likely going to record it if it's probable and reasonably estimable. So if it's over 50% chance, that's what we define as probable. We're going to both journalize the entry, which would be a debited expense, credit a payable, and we're also going to include it in the notes. Now, if it's probable and non-estimable, we have these different categories for analyzing a contingency. Probable, just the same percentage, but we don't know how much it's going to be, then that would be something we would disclose in the notes. Since we can't put a number on it, we're not going to put an entry on it. If it's possible, which is defined as greater than 20%, but less than 50, we just disclose it in the notes. We don't make an entry. And then if it's remote, less than 20%, we don't do anything. A lot of times you'll have these frivolous lawsuits. For example, somebody in McDonald's spilled hot coffee on their lap. I'm sure they get those all the time, but you're not going to see those in the financial statement notes or in the actual journal entries, because those are pretty remote that they're going to be found liable for somebody's own negligence like that.